Hey everyone, welcome back to the channel, your number one source for income-oriented investing, and it's finally here. I know many of you have been waiting for this one. Finally, we have a covered call REIT or real estate ETF, guys. That's right, Hamilton ETFs, of course, is launching a brand new ETF called the Hamilton REITs Yield Maximizer ETF. The stock symbol is going to be RMAX. Just a reminder that this will be a Canadian listed fund, a fund that is listed on the Canadian stock market. So another yield maximizer ETF, guys, in their big lineup of yield maximizer ETFs. Let's go through the ETF together real quick here, guys. So they did already declare the first distribution at 13.5 cents per share. Of course, this is an estimate. It could change. And they are also planning to launch an initial stock price or an initial NAV at about $16 a share. So you could easily calculate the yield on your own, guys, or the approximate yield rather with this information. So as usual, just like the other yield maximizer ETFs, we're going to have monthly distribution. And this is an ETF designed for income investors, right? Investors who want high monthly income. It's going to have both Canadian and U.S. REITs in here. We'll check out the composition in a second, everyone. Diversification across various REIT subsectors. So like we will see in a second, it's going to be diversified within the real estate sector. And of course, your typical covered call ETF language, right? Tax efficient distributions, reduced volatility because of those options. So the objective of this ETF is designed to provide attractive monthly income while providing exposure to a portfolio of Canadian and U.S. REITs, and of course to reduce volatility and augment the distribution income, dividend income. RMAX will employ an active covered call strategy like the other yield maximizer ETFs from Hamilton, right? And this is a non-leveraged fund, non-leveraged ETF, so no leverage here. So very important, guys. I keep saying guys, I apologize, everyone. Very important, everyone, to understand what the covered call strategy is. And this is very, very similar to other yield maximizer ETFs. So this is going to have at the money calls on approximately 30% of the portfolio. So that is the covered call strategy. We've discussed this with Hamilton several times. So essentially, let's say they are doing on approximately 30% of the portfolio, writing the covered calls rather on 30% of the portfolio. At the money, you're essentially giving up 30% upside, and you basically have 70% upside potential, just like it says here. So this is the numbers during a regular situation. Of course, it is an actively managed approach, so they could play around with the percentage as well. But in normal circumstances, you are still getting 70% of the upside of the portfolio. So speaking of which, excuse me, very interesting. This is actually going to be a 50-50 allocation, 50% Canadian REITs, 50% US REITs. 20 REITs in total, equal weighted initially at 5% each. By the way, management fees 65 basis points, very, very standard, covered call ETF fee, very similar, if not identical, to the other yield maximizer ETFs from Hamilton. So let's go through a couple of the holdings, guys. I mean, you should recognize a lot of these REITs. These are all big cap blue chip REITs, in my opinion. These are really the big ones here. No small fries. So on the first 10 are the US listed REITs. So of course you have Prologis, American Tower Corp, Equinix, which deals with data centers, Welltower, which is healthcare, healthcare REIT, healthcare property, Simon Property Group, which is malls, Public Storage, which is obviously storage. You even have Realty Income Corp, which is a very, very popular REIT discussed by many income-oriented influencers on the US side on YouTube. Very, very popular, right? Very nice high dividend yield on this one. So a really nice mix of really the 10 REITs, in the US that you want to see. And like it said in the description, very diversified within the real estate sector, within the REIT sector. Moving on to the 10 Canadian ones, it's all ones you should recognize. You have Choice, Canadian Apartment REIT, RioCan, Granite, etc., etc. So again, a nice diversification because you have residential REITs like Canadian Apartment REIT and Boardwalk Real Estate Investment Trust, but you also have industrial like Dream and Granite, and you have retail like RioCan, like Smart Centers. You have H&R, which is mixed. So really, really nice diversification. By the way, you could actually see the breakdown of the subsector here. So you have retail REITs, industrial, telecom towers, residential, data centers, healthcare, etc., etc. So I really love not only the sector composition, that it's diversified, but also the geographic composition. It's really 50% Canada, 50% US. I really, really like that. So that is it for this new REIT, Covered Call ETF. Very, very convenient if you're, a good entry point too, by the way, for real estate, because we know real estate or REITs are very sensitive to interest rates, right? There is a little bit of pressure on them when interest rates go up. I have some data for that, which I'm going to share shortly with you. But I know what you're going to ask, is this ETF, RMAX, going to be added to HYLD and or HDIV, Hamilton's all-in-ones? Well, I asked Hamilton about that and they said, we will find out as soon as July rolls around and the assets in HYLD and HDIV on their website, their holdings rather, will be updated. So we'll find out soon enough. So this is a very compelling ETF, a very good entry point now. It could be a very good entry point now. And Hamilton did share some very interesting graphs with us. And I find this quite surprising. This is a REIT, a US REIT index versus the S&P 500 since 2000. And REITs are actually outperforming since then using that date. The S&P 500, which is very surprising. Same kind of story on the Canadian market. The S&P TSX capped REIT index, which is a REIT that kind of measures all the REITs in Canada. If you're comparing that to the TSX composite index, which is kind of like comparing the overall or simulating the overall Canadian market, you actually see that the REITs are underperforming. Of course, there is a nice little big crash here in 2008. We do remember what happened, but what's very interesting, and this goes back to my point on why now could be an extremely great entry point for this ETF, is that that was since 2000. This is since 2021. And you could actually see that during this period of time where interest rates have risen rapidly, you see REITs are really underperforming now the S&P 500. You see the big gap here. Same thing on the Canadian side. I think it's even worse on the Canadian side. You see the big underperformance that Canadian REITs are having compared to the overall Canadian stock market. So when I see this kind of thing, I get excited, because as an investor, you're always trying to find a good entry point when something is undervalued, right? So this could be a fantastic time to get into this ETF, guys. So I don't have the exact date on when this ETF is going to be launched at this time, but it most probably will be very, very, very shortly, if not the day after this video is published. So keep an eye on this one, everyone. A good entry point if you ask me. I like the composition of this one. I like the fact that it's half US, half Canada, some great regional diversification. I like the fact that it's only the big REITs. And I also like the fact that it is diversified within the REIT sector. And of course, it's going to have income. It's designed for income investors, but you're not giving up too much upside. You're still maintaining 70% of the upside, which is fantastic. So all in all, I would definitely consider it, and very excited for this one to come out, guys. And if you enjoyed the video, hit that thumbs up. I would really appreciate it, and see you next time.